cap rate versus yield. So cap rates will always change in the market depending on how the market season. So for example, say medical before COVID was higher than it is now, right? So before COVID, people didn't think that they liked medical as a tenant, but they didn't want it as the tenant, right? So back then, let's say you could buy a 6% cap rate in medical. After COVID, people thought medical is really, really important, and all they want is medical tenants. So more demand, less supply, and therefore the yield or the return goes down, the value goes up. So it goes to 5%. Now, 5% is the cap rate in the market. However, if you happen to find a allied health tenant or a medical tenant that you bought for 6% on that yield, then you're doing better than the market. However, if you bought one at 4.5%, there better be a really good reason why you're below the cap rate. Maybe that tenant had a massive fit out of $500,000. Maybe the tenant's on a 15-year lease. Maybe the tenant is in a wonderful location. Whatever it is, it justifies you paying less than the cap rate, the market return for that property, because you anticipate something else happening, right? So the cap rate is the benchmark always, and the yield is always what happens individually to that property.